The Federal Reserve just ran the same play they used to save us in 2008, and this time, it triggered the worst inflation in 40 years instead of economic recovery. That should terrify you, because it means their playbook is not just outdated, it's actively dangerous. When Silicon Valley Bank collapsed in March 2023, Jerome Powell reached for the exact same emergency tools Ben Bernanke used 15 years earlier: unlimited deposit guarantees, emergency lending facilities, and promises that taxpayers would cover any losses. The only difference? This time those tools made everything worse. This isn't about incompetence or corruption. It's about mathematical reality. The Federal Reserve performed miracles in 2008 by slashing interest rates to zero, printing trillions of dollars, and convincing markets that unlimited government intervention could solve any crisis. That playbook worked so well that everyone assumed it would work forever. But here's what nobody wanted to admit. Those weren't sustainable solutions. They were emergency measures that borrowed prosperity from the future and delivered it to the present, with the bill coming due right about now. In 2008, central banks had full magazines. Ben Bernanke could slash interest rates from 5.25% to zero. The Fed's balance sheet sat at a modest $900 billion, ready to expand. Quantitative easing was an untested nuclear option that actually worked. Today, we're staring at empty casings and desperate improvisations. You want to know why this matters for your portfolio, your savings, your retirement? Because when the next crisis hits, and Federal Reserve stress tests show it's coming, our central bankers will reach for tools that no longer exist. Let me show you exactly how empty this arsenal has become. The Federal Reserve's balance sheet tells the whole story. In 2008, it held $900 billion in assets. Today, we're sitting at $7.4 trillion. That's not growth. That's desperation stretched across 15 years. During COVID alone, the Fed created $4.5 trillion in 18 months. Think about that scale for a moment. Our central bank printed more money in a year and a half than existed in the entire economy before 2008. But here's what should grab your attention. Each expansion delivered weaker results. The first round of quantitative easing in 2008 boosted GDP by 0.6%. Not spectacular, but it worked. The second round in 2010 managed 0.4%. By the third round in 2012, we were down to 0.1% GDP growth per $1 trillion printed. The COVID response? We triggered 9.1% inflation, the worst in 40 years, for barely 2% real economic growth. Your purchasing power paid the price for diminishing returns. That $4.5 trillion didn't disappear into thin air. It showed up at your grocery store, your gas pump, your rent payment. Every dollar they printed became a tax on every dollar you earned. Interest rates tell an even more desperate story. Yes, the Fed still has room to cut from 5.25% to zero again. But cutting rates in 2026 means something completely different than cutting rates in 2008. Back then, our national debt stood at $10 trillion. Today, we're carrying $36 trillion in federal debt, with state and local governments, corporations, and households piled on top. Pop quiz: what happens when you slash interest rates while owing 3 times more money? You don't stimulate the economy, you trigger a debt spiral. Every rate cut now amplifies risk instead of reducing it. The medicine has become the poison. Jerome Powell knows this. That's why Fed communications have gotten increasingly desperate. They're not managing expectations anymore. They're managing panic. When central bankers start talking about unconventional tools and policy innovations, they're admitting their conventional weapons are useless. The political capital tells the most revealing story of all. Remember 2008? Americans were angry about bank bailouts, but they accepted them. Too big to fail was a new concept. People believed the rescue was temporary, necessary, a one-time emergency response. What's our mood now? According to Pew Research, 73% of Americans still oppose bank bailouts 15 years later. Congressional approval ratings for financial rescue packages haven't recovered. The political cost of bailing out institutions has become prohibitive, while the economic cost of letting them fail has become catastrophic. This creates an impossible equation for Powell and his team. They need public support for massive interventions, but public trust in financial institutions sits at historic lows. They need congressional backing for emergency spending, but Congress can barely agree on basic government funding. They need international coordination, but currency wars have replaced cooperation. Think about your own situation for a moment. In 2008, you probably trusted that someone smart was handling the crisis. Today, you've watched the Fed flip-flop on inflation, calling it transitory until it hit 9%. You've seen them raise rates to fight inflation they caused, then pause because they're terrified of breaking something. You've watched them backstop depositors at some banks while letting others collapse. The pattern is clear. Each crisis forces central banks to deploy bigger weapons with smaller effects. The 2000 dot-com crash required modest rate cuts. The 2008 financial crisis demanded quantitative easing and zero rates. COVID required unlimited money printing and direct government spending. What comes next? What tool is bigger than printing $4.5 trillion in 18 months? Here's the terrifying answer. There isn't one. Not in the old playbook. Federal Reserve officials know their traditional tools have hit the zero lower bound of effectiveness. That's why they're frantically developing new weapons. Digital currencies, yield curve control, direct equity purchases, negative interest rates. But every experimental tool they're testing has already failed somewhere else. Japan tried negative rates for 8 years. Result? Economic stagnation and zombie banks. The European Central Bank bought corporate bonds directly. Result? Asset bubbles and pension fund destruction. China launched the world's most advanced digital currency. Result? 0.13% adoption after 5 years. The Swiss National Bank bought U.S. equities. The Bank of Japan owns more government bonds than the government itself. These aren't policies. They're acts of desperation by central bankers who ran out of conventional ammunition and discovered their experimental weapons don't work either. But our central bankers can't admit this publicly. Federal Reserve communications still pretend they have powerful tools ready for deployment. Treasury Secretary Janet Yellen still claims our financial system is the strongest in history. Bank regulators still insist they have everything under control. You know what gives them away? Their actions. Why did Silicon Valley Bank get unlimited deposit guarantees within 48 hours? Why did regional bank stocks crash 30% while regulators insisted everything was fine? Why are sovereign wealth funds pulling money out of U.S. markets at the fastest pace since 2008? Smart money recognizes what official communications won't acknowledge. The arsenal is empty, the backup weapons are broken, and the next crisis will require completely different solutions. Solutions that won't protect your savings the way 2008 solutions did. So, what happens when central banks run out of conventional ammunition? They get creative. They promise revolutionary new tools that will make old-fashioned interest rate cuts and money printing look primitive. Digital currencies, yield curve control, negative interest rates. The future of monetary policy sounds impressive until you realize it's already being tested in real time, and it's failing spectacularly. The crown jewel of next-generation monetary policy was supposed to be central bank digital currencies. The Federal Reserve has spent years promising that digital dollars will give them surgical precision over money flows, the ability to send stimulus directly to citizens, and complete visibility into every transaction in the economy. They've held conferences, published research papers, and assured Congress that CBDCs represent the future of American financial dominance. Here's what they don't advertise. Their target launch date is 2028, which means they'll miss the 2026 crisis entirely. But even if they had digital dollars ready tomorrow, we already know they don't work. China launched the world's most sophisticated digital currency 5 years ago, with unlimited government resources, mandatory adoption by state-owned enterprises, and integration into every major payment platform. The result? After 5 years of aggressive promotion, China's digital yuan accounts for just 0.13% of all transactions. Think about that for a moment. The Chinese government, which can literally force businesses to accept digital currency, achieve virtually zero adoption. What makes the Federal Reserve think Americans will voluntarily abandon cash and credit cards for government-controlled digital money that tracks every purchase you make? The European Central Bank tried a different approach with negative interest rates, essentially charging banks for the privilege of keeping money safe. The theory sounded brilliant. If you make it expensive to save money, people will spend it instead, stimulating economic growth. In practice, European banks spent 8 years slowly dying, while politicians blamed everything on American monetary policy. Negative rates didn't stimulate lending, they destroyed bank profitability. They didn't encourage investment. They created pension fund crises. They didn't boost economic growth. They trapped entire economies in permanent stagnation. The ECB finally abandoned negative rates in 2022, not because they worked, but because they were killing the financial system they were supposed to save. Yield curve control represents perhaps the most dangerous experiment in modern central banking. The idea is simple. Instead of just setting short-term rates, central banks promise to buy unlimited quantities of government bonds to keep long-term rates artificially low. Japan has been testing this approach since 2016, and the results should terrify anyone who understands mathematics. When you promise to buy unlimited quantities of government debt, you become the lender of last resort to your own government. Political spending becomes unlimited because politicians know the central bank will finance whatever they decide to spend. Japan's debt-to-GDP ratio has exploded past 250%, while their central bank owns more government bonds than their government itself. This isn't monetary policy. It's the financial equivalent of eating your own tail. But the Federal Reserve is seriously considering yield curve control for the next crisis because they're running out of alternatives. When your conventional tools are exhausted and your experimental tools have failed everywhere they've been tried, you start considering options that used to be unthinkable. Forward guidance. The Fed's attempt to manage markets through communication rather than action has already collapsed as a useful tool. In 2020, the phrase transitory inflation became the most expensive lie in Federal Reserve history. When Jerome Powell promised that price increases would be temporary, markets believed him and positioned accordingly. When inflation hit 9.1%, and stayed elevated for 2 years, the credibility damage was catastrophic. According to research from the Bank for International Settlements, forward guidance effectiveness has declined by 75% since 2020. Markets now trade inverse to Federal Reserve statements, assuming that whatever the Fed promises, the opposite will happen. When central bankers lose the ability to influence markets through words, they're forced to act through increasingly desperate interventions. International coordination, once the secret weapon of global central banking, has become impossible due to divergent economic conditions and competing currency interests. In 2008, central banks could coordinate because everyone faced the same crisis at the same time. Today, the Federal Reserve is fighting inflation while the European Central Bank worries about deflation. China is managing a property collapse while Japan struggles with demographic decline. Currency wars have replaced cooperation. When the Fed raises rates, it strengthens the dollar and exports financial pressure to emerging markets. When other central banks respond by defending their currencies, it amplifies global financial stress. The synchronized policy responses that made 2008's rescue possible can't happen when every country faces different problems requiring opposite solutions. The most telling failure involves the banking sector itself. Silicon Valley Bank's collapse taught us that deposit insurance reforms and stress testing requirements haven't eliminated systemic risk. They've just concentrated it differently. When SVB failed, depositors didn't lose money, but they learned a crucial lesson. Regional banks are expendable, while money center banks are immortal. The result? Massive deposit flight from smaller institutions to too big to fail banks. According to Federal Reserve data, the top 4 banks now control 45% of all deposits, up from 32% before SVB's collapse. This concentration makes the financial system more fragile, not more stable, because it creates clear winners and losers before the next crisis even begins. Smart money has already started positioning for this reality. Corporate insiders are selling stock at 4.2 times the normal pace, while simultaneously announcing share buyback programs. This isn't confidence, it's window dressing while executives cash out. Sovereign wealth funds have reduced equity allocations by 18% in 2024, the largest single-year reduction since 2008. Meanwhile, the Federal Reserve continues testing tools that have already proven ineffective elsewhere. Direct equity purchases, where central banks buy stocks to support market prices, worked briefly for the Swiss National Bank until they accumulated $100 billion in U.S. equities and became hostage to American stock market performance. Municipal bond purchases helped state and local governments during COVID, but created massive moral hazard problems that persist today. Each experimental tool creates new distortions, while failing to solve the underlying problem. Central banks have already deployed the maximum amount of conventional stimulus possible without destroying the currency system itself. The new weapons don't function because they can't function. They're attempting to solve mathematical problems with political solutions. But admitting this publicly would trigger the exact crisis these experimental tools are supposed to prevent. So, Federal Reserve officials continue promising that innovative monetary policy will save us from the next recession, while privately preparing for interventions that look nothing like the 2008 Playbook. The experimental tools are already malfunctioning in real time, which means the actual response to our next crisis will be something entirely different, something they're not telling us about yet. When Silicon Valley Bank collapsed, something unprecedented happened in American banking. The Federal Deposit Insurance Corporation guaranteed every single deposit, regardless of the $250,000 insurance limit, within 48 hours of the bank's failure. No congressional approval, no public debate, no legal precedent, just an instant decision to backstop unlimited losses with taxpayer money. But here's what should keep you awake at night. 3 weeks later, when First Republic Bank failed with twice as many deposits, regulators let it collapse and sold the pieces to J.P. Morgan Chase. Same crisis, same systemic risk, completely opposite response. What changed in those 3 weeks wasn't the economic math. It was the political calculation about who deserves rescue and who gets sacrificed. This is your preview of the fallback plan that replaces the 2008 Playbook. It's not about saving the system anymore. It's about choosing winners and losers before the crisis hits, then implementing those choices when markets collapse. The legal framework for this new approach already exists, buried in banking regulations that most Americans have never heard of. The Dodd-Frank Act of 2010 created something called bail-in authority, which sounds technical and boring until you realize what it actually means. Instead of taxpayers rescuing failed banks, the bank's own creditors and depositors become the source of rescue funding. Cyprus tested this approach in 2013 when their banking system collapsed. Depositors with more than 100,000 euros saw their savings automatically converted to bank equity, worthless equity in failed institutions. The European Union called it a successful resolution because taxpayers didn't foot the bill. The Cypriot depositors who lost their life savings probably had a different opinion, but Cyprus was just the pilot program. According to the Financial Stability Board, every major economy has now implemented bail-in legislation, including the United States. The Federal Deposit Insurance Corporation has legal authority to convert deposits above the insurance limit into equity stakes in failed banks, and they can do it without asking permission from Congress or even notifying depositors in advance. Here's where it gets interesting for your personal finances. Only 30 American banks are designated as systemically important and guaranteed government rescue in the next crisis. The other 4,970 banks in our system, they're subject to bail-in resolution, which means their depositors become involuntary investors in failed institutions. Think about your own banking relationships for a moment. If you keep money at J.P. Morgan Chase, Bank of America, Wells Fargo, or Citigroup, you're probably safe because these institutions are too big to fail and politically connected enough to guarantee rescue. If you bank at a regional institution or community bank, you're gambling that your deposits will stay below the insurance limit when the crisis hits. But even the insurance limit isn't what it seems. The FDIC's Deposit Insurance Fund contains about $128 billion, which sounds substantial until you realize that American banks hold $17.6 trillion in total deposits. That's enough insurance to cover less than 1% of deposits in the system. When multiple banks fail simultaneously, which is exactly what happens during financial crises. The insurance fund becomes worthless. The FDIC can borrow money from the Treasury to cover additional losses, but only with congressional approval during a declared emergency. And we've already established that Congress has no appetite for bank bailouts after 2008. So the insurance system works perfectly for isolated bank failures, but collapses entirely during systemic crises, which is exactly when people need it most. Financial repression represents the other half of this strategy, and it's already being implemented in real time. The basic concept is simple: cap interest rates below the inflation rate and force financial institutions to buy government bonds, creating a captive market for government debt while slowly eroding the purchasing power of savers. The Federal Reserve has perfected this technique over the past 15 years. Even with recent rate increases, real interest rates, adjusted for inflation, remain negative for most savers. Your money market account, earning 4.5%, loses purchasing power when inflation runs at 3.2%. But the government benefits because they're borrowing money at rates below the depreciation rate of the currency. This isn't accidental policy. It's deliberate wealth transfer from savers to debtors, with the government as the largest debtor in the system. According to research from the International Monetary Fund, financial repression allowed the U.S. government to reduce debt to GDP ratios by 3 to 4 percentage points annually during the 1945 to 1980 period. They're using the same playbook today, just with more sophisticated terminology. The corporate sector has already started positioning for this reality. Share buybacks hit record levels in 2024, while corporate insiders sell stock at 4.2 times the normal pace. This combination makes perfect sense if you understand what's coming. Companies are shrinking their equity base through buybacks, while executives cash out before the crisis hits. When markets collapse and bailouts begin, these companies will have fewer shares outstanding and more cash-rich balance sheets, while their former executives will be safely invested in hard assets. Sovereign wealth funds tell a similar story. According to the official Monetary and Financial Institutions Forum, sovereign funds reduced equity allocations by 18% in 2024, while increasing holdings of physical gold, real estate, and commodities. These institutions manage money for entire countries. They have access to the same intelligence that guides central bank policy. When sovereign wealth funds start selling financial assets and buying real assets, they're positioning for currency debasement and financial repression. The timeline for this transition is already visible in Federal Reserve stress testing scenarios. The 2024 stress tests assumed unemployment rising to 10%, GDP declining by 4%, and commercial real estate prices falling by 40%. These aren't random numbers. They're the Federal Reserve's base case assumptions for our next economic downturn, and their stress tests show that most regional banks would fail under these conditions. But here's the critical detail. The stress tests also show that the 30 systemically important banks would survive these conditions with minimal capital impairment. This isn't coincidence, it's planning. The Federal Reserve is publicly documenting which institutions will survive the next crisis and which ones will be sacrificed to protect the survivors. International coordination has completely broken down, which means every country will implement their own version of financial repression and selective bailouts. The European Central Bank is already buying corporate bonds to suppress borrowing costs for favored industries. The Bank of Japan owns more government debt than the Japanese government itself. China's central bank directly controls credit allocation to state-owned enterprises while letting private companies fail. This fragmentation means the dollar's reserve currency status becomes even more important for American savers and investors. Other countries will protect their own financial systems first, which means dollar-denominated assets get liquidated during foreign financial crises. We saw this pattern during the COVID crisis, when foreign central banks sold $100 billion in U.S. treasuries to fund domestic stimulus programs. But the most revealing indicator involves duration exposure in financial markets. When central banks implement financial repression, they cap interest rates below inflation rates for extended periods, sometimes decades. This makes long-term bonds incredibly dangerous investments because their fixed interest payments lose purchasing power every year, while their principal values get eroded by negative real yields. Smart money is already positioning for this reality. According to Federal Reserve data, commercial banks have reduced their holdings of long-term treasuries by 15% since 2022, while increasing short-term holdings. Insurance companies and pension funds continue buying long-term bonds because regulations force them to match long-term liabilities. But hedge funds and private wealth managers are actively shortening duration exposure. The fallback plan is already operational. It just hasn't been activated by a major crisis yet. Bail-in authority exists, financial repression is partially implemented, and the list of institutions designated for rescue versus resolution has been finalized. When the next crisis hits, regulators won't need to invent new policies or seek congressional approval. They'll just implement the framework that's already built and waiting. The 2008 Playbook worked because central banks had ammunition and markets believed rescue was temporary. The 2026 reality involves depleted tools, broken alternatives, and a documented strategy that requires savers to fund the bailout while debtors receive protection. The desperate new strategy isn't theoretical. It's already written into law and regulations, just waiting for the crisis to flip the switch.